We haven't seen this short interest in the last 5 years. We're at the 99th percentile of short interest. Everyone hedged and then kept hedging. And then right when they're not supposed to hedge, they just hedged some more. And what you saw in markets today, Monday morning, strong gap up openings, MSTR gap up and running. I have a basket I call Twitter momentum stocks. They're all up strongly. So the headline is animal spirits are back, and crypto and Bitcoin are part of animal spirits.
Hi everyone, welcome to Bits and Bips, exploring how crypto and macro collide 1 basis point at a time. I'm your host, Noelle Acheson, high seer and keeper of the Crypto is Macro Now newsletter. I'm here with Alex Kruger, Kruger Macro of House Asgard, protector of the realm, and Ram Ahluwalia, Meister of Wealth, leader of Lumida. Hi guys.
How's it going?
Hi everyone.
Today we are joined by Felix Jauvin, the golden voice of the Forward Guidance podcast. Hi Felix, thanks so much for joining us today.
Hey everybody, super excited to be here. I'm a big fan of this show, and so it felt wildly overdue to be on the show and be with you guys. So yeah, super excited to dig in.
We're so glad you're here, and I'm sure that many of our listeners are also fans of your show, and if not, they should definitely check it out. Now, we're here to discuss the latest stories in the worlds of crypto and macro, but just remember that nothing we say here is investment advice. Do please check unchainedcrypto.com/bits and bips for more disclosures.
Crypto moves fast. It's why Bitwise launched the weekly CIO Memo, a jargon-free summary of what's moving crypto markets, written by one of the best in the business, CIO Matt Hogan. Get up to speed in 5 minutes or less. Check it out at bitwiseinvestments.com/CIO Memo. Carefully consider the extreme risks associated with crypto before investing.
Now with that, let's dive in. There's so much to get through and things are changing at breakneck speed. We have to open with the macro story of the week, and we're recording this on Monday, so things are in flux. But the word of the week is tariffs. Now, Trump has been referring to April the 2nd as Liberation Day, the day the US gets to apply reciprocal tariffs to any nation who has dared to apply tariffs on US goods. Now, there has been little detail forthcoming on what that means, and the idea of matching tariff for tariff around the world sounds like an administrative nightmare. But the uncertainty and the potential magnitude of the move has been enough to get investors nervous. Trump has also said April the 2nd was the day sectoral tariffs on automobiles, pharmaceuticals, and semiconductors, and probably some other sectors, would also kick in, adding further confusion of nobody knows, would these be added on to the reciprocal tariffs, or would they be incorporated? No one seems to have had an answer. However, to add to the confusion, yesterday, reports emerged that Trump is changing his mind again, and that sectoral tariffs will come later. Today, he repeated that a couple of times. He said that automobile tariffs would be coming, and he said very shortly, his words, and that new pharmaceutical tariffs would be coming at some point in the not too distant future. Again, his words. And said, we're recording this on Monday. Wednesday might, by the time this comes out, might be a totally different story. But the markets are liking the relief, which shows just how worried the market was, because reciprocal alone sounds pretty bad. Now, stocks are up, crypto is up, but this seems like the confusion has ratcheted up, and confusion is never good for markets. Who wants to jump in on this first?
You'll see this Bloomberg article that went around Twitter. This is what really stoked markets today, right? It says, the wave of tariffs is poised to be more targeted than the barrage he has occasionally threatened. I love the use of the word barrage that Bloomberg writer put in there. Interesting word choice. Like, probably not a big fan of tariffs, but this is it. This is what lifted markets, right? Tariffs started the correction from elevated, vulnerable conditions, and then tariffs also are ending the correction.
Yeah. Do you think this is the tariffs, the pivot in the mood that is ending the correction, or might there be something else at work here? Felix, what's your take?
Yeah, so the way I think about tariffs is in two ways. So one angle or one side of the blade of this whole tariff thing is that they want to lower tax rates, they want to lower spending, and one of the ways that they want to bridge that gap is to bring forth tariff revenue, which is, a form of a tax, really. It's just, taxing a different base, really. But, for them to go about doing their fiscal goals without blowing out the deficit, some version or another of increased tariff revenue has to fill that gap, unless they want to run wider deficits, etc. So there's that side of things, which is, more so what I feel like Scott Bessent talks about in many interviews, where, there's this idea of this replacement. And then on the other side of things, there's this discussion of tariffs as used as a negotiation tactic for two major goals. To, on net, we've seen a major shift towards, reciprocal tariffs as opposed to just outright, tit for tat. So with that idea in mind, perhaps there's this goal to use it as a negotiation tactic to get to a point where there's actually less on net tariffs than when we started this whole mess. But the issue with that is that if we end up with actually less tariffs, let alone more tariffs, that goes against this premise that I first mentioned, which is filling that gap for fiscal revenue. So it's really difficult to square those two things. And I think, putting those two things at the end of just the distribution of outcomes is why I think volatility remains so high right now in markets.
Alex, do you have thoughts on that?
I mean, I agree with with what Felix is saying. That's how to put it. That's the way the Trump admin looks at things, right? Now, in the meantime, these measures, and especially the way they have been communicated, which has been insanely all over the place, with very constant back and forth across items and across countries, this brought, as we all know, volatility to some absurd levels that we see rarely on market crashes, with the VIX hitting 30 briefly, which is a lot, right? Something interesting, I think, that we are seeing is that on the we have two crowds. We have the trading crowd, the markets guys, the traders, sales guys, the guys sitting on the trading floor, what we call the front office. And we have the research guys, economists, and the fundamentalists, and the guys who focus on valuations, for example. And there is some sort of disconnect there. The view on the economy derived from what Trump and his administration have been pushing is extremely negative, and everybody has already put their estimates on earnings growth and the economy sharply lower.
Yeah, I just put up on the screen a chart that I saw on Bloomberg the other day about the number of times tariffs is being mentioned in earnings calls and investor presentations. And we've got Q1 earnings reports coming up soon, so we're bound to hear it even more.
Yeah. So my point there is that economists are extremely pessimist. However, this is already, the way I think about it, this is already in the price. Everybody has already lowered their forecast on the economy from 2.8% for this year to somewhere between 2.2 to 1.8%. This is already in the price. So I think traders who are actually looking for bad hard data to drive the market, they're going to be surprised, because what really moves the market is not really the data being lower. It's basically how the data comes in versus the forecast. And the forecast has already been dramatically lower. Sorry for being repetitive. Something very interesting that I'm not sure many people caught is that the forecasts from the Fed, that the Fed published on its last FOMC last Wednesday, that they're very bad. They include worst case scenario. Powell explicitly said that the forecast that the Fed published, they include max retaliation from their trading partners. So that's a silver lining, that basically it takes very little for things to turn around, like we just saw in the last 24 hours. We had a good headline on noon on Friday from Trump. Then we had those comments from White House advisor Hassett. There was I think it's the same Bloomberg article you're talking about, Ram. Yeah, that's the one. It came out on Sunday around noon as well, and that's what's driving the market. Exactly what's going to happen on tariffs, we don't really know. I don't know. I'm trying to figure out and trying to see what's priced in. What I do know is that the street is literally all over the place, with some people calling for like doomsday, and some people not. And very aggressive tariffs are priced in. Like, let's put it this way: and with this I pass it on. Don't want to talk too long. It's like the base case scenario. It's basically tariffs going up to basically 10% on imports on April 2nd. That would be very aggressive. That's in the price, supposedly. That's what I'm gathering right now. It's like, to be more precise, I'm not there yet. Yeah.
Not in my head, and kind of fully agree with all the comments here. Look at GM. GM is up 3% today. Hasn't been this high since January 28th, which is before the tariff talk. So tariffs are priced in. I agree. And on the economic data, the soft data has been weak, but the hard data has been strong. The soft data are the surveys, but the hard data, non-farm payrolls is fine. Initial claims are fine. We talked about this last Monday. Like, there is no recession. We don't see any evidence of that. Earnings are fine. They're going to do really well in April because, to your point, Alex, the expectations have been lowered. And we're back to risk on. Correction is done. More than done. You can put a fork.
Hopefully. What did you guys think of the FOMC meeting last week and Powell's dodging around the idea of tariffs?
Yeah, I think it's an interesting circumstance. Like, this is why, I'm not going to go as far as saying that this is a stagflationary situation. I think there's stagflationary vibes, which is that there's a downside risk to the growth outlook and upside risk to core PCE, which is basically the main takeaway I had from their SEP data. They see growth risk, but they also see PCE remaining high. And what does that net out to is, a maintenance of where they're at in terms of cuts priced in. So, 1 to 2 cuts, maybe. I think that creates quite a difficult situation for risk assets. I agree the correction is largely done. I totally agree that, the economic data isn't bad enough to be worried about recession, but that leaves a difficult spot for both the Fed and then therefore Trump and Bessent to be in now, where it's like, okay, well, if we threw a 10% equity correction and all we got was 50 bips off the 10-year bond yield, that's a pretty expensive trade-off, And so if they're focused on trying to get the 10-year lower, like we've seen bonds sell off pretty significantly today as equities rallied, as that continues, what does that do to the reaction function of Trump and Bessent? And based on that reaction function, what does the Fed do? The Fed probably does nothing. So when you look at the outlook, I think risk assets are somewhat dead money, but at the same time, I don't see much more downside deterioration, especially when you bring forth the economic data that we've seen, which is mostly fine.
Mostly fine is the key, though. We got the PMIs, the preliminary PMIs today, which show that the prices paid index is up at its highest in 2 years. So this is going to feed through to Fed decisions as well. I am perennially optimistic. I mean, my friends always laugh at me about how optimistic I am. So I find myself in the usual situation of actually being the most pessimistic in this group when it comes to, is the correction over? I'm afraid that I have a feeling we do have more because the valuations have been unrealistic for such a long time that to justify them, we're going to need earnings to grow a lot over the next year, and I just don't see that happening. I seriously hope I'm wrong.
I can tell you, my team and I look at a lot of data. We do a lot of studies. Funny thing, last week we saw all the studies were saying the comparable changes and the variables we look at is similar to COVID, and yet we're not in COVID. This is 1, 2. I'm not trying to make the case the correction is done. I think it's definitively behind us. That doesn't mean that this Tuesday we don't get a natural kind of pullback and then rally from here. But I think Felix's question's right on the mark, which is, what do you do if you're Bessent and Trump? You were maybe hoping for a 10-year to go lower to reinvigorate the mortgage market. Now it's not happening. And it didn't respond in the way that it did in September when you had a deeper growth scare now because you got competing assets like European bonds. I think it's a real question. Now, the other, Felix, one approach to that answer might be, if you're Bessent and you lean into capital markets and lending, right? Bessent wants banks to lend. If you've got trillions in low interest rate 5-year money debt to refinance, then let capital markets soar, let banks get back to lending, which doesn't help the U.S. government refinance its debt, but it can certainly support tax revenue and growth. So that actually is the other approach, and it makes a lot of sense, right? If you're concerned about commercial real estate debt on balance sheet, let companies refinance through capital markets and bank lending rather than try to lower the 10-year in a way that's might help the U.S. government but hurt the private sector. And if the private sector would weaken, that actually would increase the deficit if you actually had economic weakness.
You know,
I
I want to
that
say
point.
something quickly. Just quick comment, but pass it on to you, Felix. After it's on the correction being over. I don't know if maybe that came across as that I think that way. I don't think that way. For me, is unfortunately is I don't know, and I will know on. I hope to know on the second if that was it or we see another leg lower.
Aren't we going to front run the second? Aren't markets going to anticipate? Markets are front running off the Bloomberg headline.
Well, yeah, but we can't anticipate. The worst is we can't anticipate Trump. He's been flip flopping very aggressively. Like today is but quickly here is very easy, and actually it's hard to stop being bullish. It's hard to fight this bullish sentiment, especially when one is long and has a long bias after such a massive rally, you know. But the rally was driven by headlines, and things could easily flop on the second. And the last thing here is I do think that if we hit worst case scenario, and unfortunately things go bad and we end up having 15% tariffs in aggregate in the US rather than 10, which is the base case supposedly. This is like a 2-week correction. It's fast and furious, and in 2 weeks that's your bottom worst case scenario, I think. Good case scenario, base case scenario, bottom is already in.
And we did get the good news from QT being pretty much over last week.
I was just going to say I have a slightly different outlook on how tariffs get digested by risk assets. I think if we get certainty on what the tariffs will actually be, risk markets can digest it, move forward. The issue is that we don't have that certainty and it keeps changing. So I think, yes, there's an air pocket where right now we're pricing in marginally good news in terms of tariff outcomes on April 2nd. And if we start to see more headlines in the lead up that are negative, yes, that could lead to some lower equity prices. But I think if we get to April 2nd and we understand a tangible framework for the specific subsections that they're going to tariff, I think the equity market can move forward from that. Vol can come off, and just from vol coming off, we can see that marginal return to bid. I totally hear you where you're saying about valuations are expensive. And, I do take a bit more of a flows-based approach where, you've seen a lot of money like totally 180 into rest of world assets recently over the last few weeks, like Europe, et cetera. At the same time that people have just been dumping their Mag 7, at the same time that people have been, they've had some like target date funds have been doing pretty well in terms of their long bond side of their trade. And now they need to rebalance and get more into equity and sell some bonds. And so I see that happening right now at the month end. And it feels like some of these flows can offset it. But I think the biggest thing is if we can just get some sort of certainty on what's going to happen, risk assets can start to at least digest that. And maybe that means a few percentage points lower, but I don't think it means like another 10%.
I would agree with that. I would say, by the way, the correction actually ended like on March 13th. It doesn't feel like that. But if you look at leaders in the various sectors, they've bottomed some time ago. Look at the data center theme. A stock like Powell, look at Google, look at NVIDIA, they've already bottomed. Look at even MicroStrategy, it broke out today. So the correction already bottomed. It's already in the rear view. The other part is tariffs can be avoided. Trump is going to get a deal done with Mexico. He needs a strong neighbor in Mexico to stop illegal immigration, to stop fentanyl, and to ensure that drug cartels don't run the country. That's really the only analysis that needs to be done. If that's the case, then you can avoid tariffs by shifting production to Mexico. And so I think that's likely going to happen.
And there's the potential boost from a ceasefire agreement in Ukraine, which Trump has said he wants in place by April 20th, which would make Easter certainly something to celebrate. But it's also looking ambitious since Putin doesn't seem to be in any hurry. However, that's a very complex issue. But imagine if they do get something like that.
There's positive news like that. And to your point on the Fed put us back. The Fed capitulated in their dot plot. They said we expect lower growth, higher inflation, and we're going to cut rates anyway.
Yeah, 100%. But they need the certainty from Trump and Bessent to act on it. So if that takes too long, that can create an air pocket where they're slow to react, and then suddenly those 2 cuts could become 4, but they could be bearish cuts. That's the left tail risk I'm worried about.
What do you think the market is expecting around the relationship between Trump and Powell? Today, Trump was saying should have cut interest rates, whereas over the last FOMC, Trump was actually supporting the decision. So, does the market care about this?
I originally thought that Powell and Bessent, there's this. It's become well known that the Treasury Secretary and the chair of the FOMC meet every week for lunch and discuss different policies. And I noticed a few different cross currents that got me really interested. Suddenly, out of nowhere, in the last 2 months, we've seen a lot of talk from both sides about this SLR exemption being exempted in the next couple of months, and that's a complete 180 from where Basel III endgame regulation was headed over the last couple of years. So it's really interesting to see that sort of perked my ears up a little bit to think about. Okay, well, perhaps Bessent and Powell are actually a lot more aligned than what a lot of people think. I think the wrench is what you refer to, which is Trump, randomly tweeting, "Hey, Powell should have cut rates." But I think, that's the issue with Trump, is sometimes he will just say something that is off what everybody else agrees with, and then there has to be this catch-up game. But I think overall, there is this agreement that, when you think about what Powell has had to deal with for the last 3 or 4 years, why has inflation not returned to 2%? I think because of high stock prices and fiscal deficits has created that bid. So if they're focused on marginally bringing lower equity prices to get a long bond rally, at the same time that they're trying to cut down deficits, that ticks a lot of boxes for Powell achieving his 2% goal. So I do think there's more alignment than what it's expected, but at the same time, there can be these off-the-cuff tweets looking for...
That must be one hell of a breakfast they get every Monday. Who served the food?
Waffles.
What's your
I hear they have waffles.
The waffles, sugar, carbs. I want them on a high protein, low sugar diet with a double espresso.
Yeah, get Kennedy on the case.
No cream. Yeah.
No, so basically getting inflation down then, to carry on with your thread, Felix, would be slowing down economic growth basically through lower fiscal spending or any other means that would check the boxes. And that would, of course, add to uncertainty because we have part of the administration, such as Bessent and Trump, saying, yes, there is going to be short-term pain. And then we have other parts of the administration, such as, I flew up on the screen earlier, the likely head of the economic advisors for Trump saying, no, we don't see any economic pain from tariffs, should just be, blink, nothing else. So there's even confusion, it seems, within the administration, partly because this is new territory. Lutnick is talking about launching next week the External Revenue Service. So that obviously does position tariffs not just as strategic, but also as a revenue driver. And should we get that economic slowdown, I don't know if any of you saw the interview with BlackRock's head of digital assets, who is talking about a recession being good for Bitcoin. Robbie Mitchnick was saying that a recession could actually end up being a catalyst. Let me get this up on the screen. I won't
talking about tokenizing Ethereum, if I recall, as well, right?
I mean, if a recession is good for Bitcoin, I'm Jane Fonda. I don't know.
I mean, maybe on the other side of things, after it's down another %, it would be good because QE comes back or whatever. Rates are back at zero. But yeah, there's a lot of pain in the interim.
That's a 3D chess answer, right? After it goes down, it will go up.
Where I think he's coming from is BlackRock has always positioned Bitcoin as a store of value. They're the digital gold camp, 100%. And they've actually been out there saying, no, it is not a risk asset, which I found very annoying because it's not up to them. If the market sees it as a risk asset, it's a risk asset. However, they're pushing the digital gold narrative, and that's maybe what he's talking about. When things get hairy, you go for your digital gold and your real gold or whatever, perhaps.
I mean, I think in that same vein, it's only on the other side of the leg, because if we actually get a recession, like if you just look at every, gross scare / recession since 2006, like the velocity keeps increasing, and the velocity keeps increasing because we have more leverage, we have more margin calls, we have quicker, VAR degrossing. So, every gross scare, even gold gets sold. Like everything other than T-bills and cash gets sold. So I'm not a big believer of that narrative.
Yeah, I totally agree. Now, we don't have James here to talk us through the latest in the ETFs, but one growth driver that I was talking to someone about earlier today is the potential flurry of approvals that we will get when the SEC chair is confirmed, and his confirmation hearing is on Thursday. It's not expected to be controversial. So do we think ETF approvals will be a driver for any, or do we think there's really not that much institutional demand for a Sol ETF, for instance?
Do you have a view on Solana?
I think Sol is an exception. Is the only exception, actually. I'm also hoping that is the case, to be honest. All the other ones, they seem to be more of like a marketing stunt to get people to tweet about it and get price to react. Yeah, I'm not. It's ETFs are becoming commoditized. Unfortunately, too many of them. That's my view.
Yeah, I mean, I totally agree. Like, it doesn't James, I'm sure would explain this further, but there's not much cost for them to just like throw ETFs against the wall, and then if they don't perform 3 months, 6 months later, they can just delist. And the same way that like centralized exchanges will list a token when it's hot, and then 3 months later they'll delist it. Like I've seen a few meme coins start to get delisted, and nobody really they all talk about the listing, but nobody really talks about the delisting that much. So yeah, I think it's just throwing things at the wall and getting attention. I think the biggest driver for ETFs has still been fast money, pod shops and stuff running basis trades. There's been a little bit of small allocators. There's been, obviously a lot of people that were holding Bitcoin on chain or something for that and wanted to rotate it into a tax sheltered account. I think that's been a big driver. But yeah, overall, I don't see anything too exciting other than maybe Solana, like Alex said. I'd agree there could be some interesting adoption there.
So here's some numbers I got on operating an ETF. So cost of operating an ETF is around $200K a year. So if you have 25 Bips on fees that you're charging your buyers, your holders, you need 80 million in AUM to break even. Now, shitcoin, with all due respect, shitcoin ETFs, I'm pretty sure they have higher management fees. So their break-even would be lower, but it's still not that easy to get to, let's say, 30 million in AUM for like marginal, like fringe coins. Like we saw like the Pengu ETF just announced. It's like, sorry, insane. Who cares about Pengus and TradFi,
Yeah, and what you'd need to pay the market makers to actually make a market for you in something as illiquid as that. They would charge for taking on that risk.
Hey everyone, Matt Hogan here, the Chief Investment Officer for Bitwise Asset Management. In this week's CIO memo, I tackle the great de-risking of Bitcoin and why I think this is the single best time in history to buy Bitcoin on a risk-adjusted basis. Find out why at bitwiseinvestments.com/CIO memo. That's bitwiseinvestments.com/CIO memo. And thanks.
Carefully consider the extreme risks associated with crypto before investing.
I want to show you this tweet by Michael van de Poppe and get your views on what he says. I thought it was one of the more interesting ones I've seen on the recent market mood shift, especially as it comes to crypto. Michael van de Poppe says, I think that there's a significantly higher chance that we'll be trending upwards on Bitcoin and Ethereum than downwards. Panic is gone surrounding tariffs, as we were just saying. Japan didn't hike. We haven't talked about that. Massive downwards move on the dollar. The environment changes and price usually moves in opposite of sentiment. Thoughts?
Like, this is an interesting thing. Is like the focus on Japan. Like, Japan doesn't matter right now. Let's put it that way. It's people in crypto are overly focused on Japan. It's kind of sucks to be harsh on people that I don't know, but if you're talking about Japan in 2025, it's basically you have a carry trade PTSD from August 2024, and it happened to a lot of people. And I get a lot of questions on every BOJ meeting. It's like, what's the BOJ going to do? And the answer is it doesn't matter, because the carry trade mostly unwound, and it doesn't matter anymore. So the world is already complex enough. Let's try to focus on the few things that do matter. So that's what I think. And I hope he's right on Bitcoin and ETH. It looks that way. And I'm being repetitive. Maybe, okay, let me change it quickly here for you guys. What do you think would happen with the S&P if Chinese tariffs, if Trump delivers what he promised in the election, during the elections? which was basically 60% tariffs for China. What if Trump basically rolls back on that and Mexico and Canada end up with 25% tariffs across the board?
Well, so Alex, you're right. It'd be risk off significantly, but it's not probable. It's not probable.
That can happen.
So look, I'll share the screen with you here, which shows the short interest in markets, which reflects a lot of the bearish sentiment. We haven't seen this short interest in the last 5 years. We're at the 99th percentile of short interest. Everyone hedged and then kept hedging. And then right when they're not supposed to hedge, they just hedge some more. And what you saw in markets today, Monday morning, strong gap up openings, MSTR gap up and running. I have a basket I call Twitter momentum stocks. They're all up strongly. So the headline is animal spirits are back, and crypto and Bitcoin are part of animal spirits. The IPO ETF, unprofitable tech companies, part of animal spirits. So they are back. I wouldn't be surprised to see some backing and filling tomorrow, just like we had last week. Friday strong, Monday strong, Tuesday backfilled, and then rally from there. But we are now back on risk on. Look at Palantir. I mean, these are bubble stocks. Palantir, it doesn't matter though. Palantir up 6%, right? So
not long Palantir, so it doesn't matter.
Yeah, that's also the defense story in play though.
It's more than Palantir. Look at HIMS. I could send you many tickers. I'll share my screen here to show what I mean as Twitter momentum, but this is, I think as important as like the beta factor. It's the animal spirits. Like Tesla up 11%, 12% a day, right? It was getting thrashed down 50%. Robinhood.
I think this is the pod shop monkeys piling back in again.
Short covering also. So pod shop monkeys, animal spirits, Reddit. Look at everything up in animal spirits, up 5.4% after getting destroyed. It was down 17%. Now it's down 12% once you add back today's gain, right? But so, I think that's it. Animal spirits are back now.
Would you deploy today, Ram? Like, let's say you have like today, like right now.
This morning was my last deployment at the open, right at the open. But at the close of today, I bought SQQQ. So the little tactical, because I do think you get back in and filling, actually.
This is why we always get given so much crap about being called flip-floppy, is because we're trading different time horizons. You're allocating, but you're also you're also shorting a tactical trade.
Right at the close, 3:55 p.m. I did the same thing Monday of last week, and it worked out. And it's just a tactical maneuver.
It's perfect. It's perfectly if I understand. But it's just it's like the audiences we know they get upset about us flip flopping, and we flip flop. It's
that's the idea.
That's within 24 to 48 hours, though.
Yeah. The way I think about like tariffs being priced into currencies, so I'll just try to share my screen here. But just looking at like the U.S. Canadian dollar and Mexican peso, so there you can see the tariff headlines on this chart, right? It's just like we've been in this range where some version of it is priced in, and then no tariffs, and we see the relief, and then the opposite when we get the tariff headlines. So it's interesting that the U.S. Canadian USD CAD remains range bound, but we do see that Mexican peso rolling over a little bit. So perhaps to your point, there is marginal pricing in of a better resolution for Mexico right now. But I think overall there is a decent point that there is, I think, still some complacency in terms of what's present in the tariffs. But in the same vein, when I see the back and forth where it just feels like constantly, as soon as we get to the X date, the next one being April 2nd, we start to see a lot more positive news coming out of it. So I do feel like this pricing in is quite rational, but it does create that left tail risk. I do it.
What other markets?
What do you guys think? Question for you guys. What do you think of the following? This is a view of some people in the market. Is basically long equity, short crypto. Beta adjusted, right? But it's
oh man, I'm doing the opposite.
Yeah.
In 3 months, that's a good idea.
I
mean that's wrong. This is risk on. This is global risk on. So I think it's like the wrong concept. What I would do is short Brazil, EWZ, on a stronger dollar I think the timing on shorting Brazil now is actually very good. We're short Brazil as of this morning. And I think you're going to see money rotate back in from China and Europe to the United States, which is happening now already.
Alex, that's such an interesting idea because I've been playing around with the opposite of short QQQ, long BTC, and this is why. If you look at what's going on in the rest of the world, I call it fiscal unshackling is happening. You have Europe that's looking to go pretty large in size, $500 billion investment, taking off the debt brake. You have China starting to finally move on the fiscal side of things. So the way I think about it is, if I think that U.S. equities are still, even though I think again the potshot monkey bounce trade is in play right now, I do feel like it's somewhat limited in upside. So if I'm like you say, beta adjusted or vol adjusted, short Qs, long PTC, if I believe that BTC is a global asset, that's still, obviously it's largely driven by US macro liquidity, but if I think it's powerful enough in the rest of the world, at the same time that on the US side of things, they're attempting some version of austerity, I think that's basically, it's like a money printer trade. It's like long rest of the world money printer, short fiscal austerity in the US. So I'm on the opposite side, long BTC.
Isn't it short bonds the move? Like all the economic data came in strong. Hard economic data came in strong. Inflation is still higher and stickier than people expected. You're going to have good earnings next month. I'm not saying actually go on short bonds, but I'm just saying that in terms of what a lag, I would say it's bonds.
Yeah, I think you're right. It just comes down to how it sits within your portfolio. Like I own some bonds, but it's 70% of the size that I had a month ago, and it's just as a hedge. So yeah, it's contextual, but that is another good way to express it.
Alex, what's the justification for the short crypto position at this stage? The long stocks, short crypto. What reasoning are you hearing?
It's just people are bearish. It's the usual. I mean, I presume that the answer was not. I mean, we're self-selecting here, right? But the view is that there's no demand for on-chain activity, and that institutional demand for crypto, for basically putting real-world assets on chain, doesn't really accrue value to the blockchains. Like what actually drives to the blockchain assets, right? The souls of the world, the ETH of the world, and those are mostly retail-driven speculative assets. That basically is monkey on, monkey off. That I mean, some people are fundamentally pessimistic on most crypto assets, and to be honest, it's like I feel the same way, but I would never short crypto for more than a few days because I think it's suicidal. It's just not how I operate.
Yeah, an unlimited downside. And also, as Felix was saying, in the macroeconomic and geopolitical shifts, I mean, longer term, it's just, they're global assets and they're not going to be buffeted by economic concerns, risk concerns, but not economic concerns. But segueing into what's going on between Bitcoin and ETH, we talked about that many times on the show before. ETH is unloved, ETH is overlooked, but I'm sensing amongst all of you a shift in expectations of ETH, a bit more hope that it could rally from here.
Quickly from me, I think, I mean, it's probabilistically speaking, it's either, so best case scenario, it rallies a lot. Base case scenario, I think it rallies. Worst case scenario, it starts rallying in say mid-April or third week of April. So from a directional perspective, I think it's a good time. The question for ETH is not if ETH rallies or doesn't rally, is how does it trade against other crypto assets? That's the problem. That's what everybody's so upset about. And what do you guys think?
Yeah, it's still hard for me to leave and decide to leave Bitcoin and go anywhere else right now, for the most part. I think it's an important point. It's, ETH can rally, but it's just, relatively speaking. I think the only real upside tailwinds I can see for Ethereum right now is one that in most delta neutral trades, when you talk to liquid funds and stuff, a lot of them, their short leg is Ethereum and then they'll long something else. So perhaps if they get squeezed on that short position for one reason or another, that can be, I think that is mostly why, you always see at the end of these rotational shifts that the last phase of it is doing really well, relatively speaking. And then we fall down lower. And I think it's because a lot of those funding legs of the shorts are closing. So that's one. And then I think the other potential tailwind is just as you know, I was at the Digital Asset Summit last week and just talking to a lot of institutions and that sort of capital. A lot of them are talking about wanting to allocate, and I think it's a lot safer for these bigger institutions to allocate to Ethereum. You know, even if you might say that, you know, the technology is more innovative or whatever on Solana or whatever other chain, it just doesn't have the same time tracker. And that's really important for institutions. Is you just, you know, it's the same way why everybody will be excited about a new hedge fund that launches, but nobody's going to invest until they have at least a couple of years of track record. So that really matters in that world. So you could see this, and we have seen this. You know, I think I saw a headline this week about Fidelity launching something on Ethereum. So I do think they will simply allocate because of the track record that Ethereum has.
Yep, Fidelity are going to be tokenizing. So go ahead, Alex.
Let me flip-flop again. So a silver lining for ETH is it compared to Sol, the key man risk is considerably lower. Sol has two very, very powerful founders in the sense that they drive the chain. ETH doesn't have that, which has been, I think, one of the many reasons for its underperformance. But you turn it upside down, and it's actually also something positive. It's like you could think that you eliminate the key man risk, as simple as that.
I'm going to read out, speaking of the institutions at DAS, BlackRock's head of digital assets, Robert Benchnick, is back, and he was saying this at the conference about Ethereum. Quoting here, "The negativity around Ethereum is very overdone. There is a lot to be optimistic about. There was no question that the blockchain we would start our tokenization on would be Ethereum. And that's not just a BlackRock thing. That's the natural default answer. That's really important. Clients have clearly made the choice that they really do value decentralization, credibility, and security. And that is a great advantage that Ethereum continues to have." I continue. "ETH is a bet on blockchain adoption and innovation," per to your point, Alex. And continuing finally, "ETH is a bet on tokenization, stablecoin adoption, and decentralized finance." End quote.
ETH is a natural
Taylor.eth
of decentralized exchange.
And it's got the community. And yeah, as you were pointing out, Felix, Fidelity are going to be tokenizing a money market fund and issuing a new class of shares, which will be on Ethereum, which is actually interesting. It's not harnessing the full efficiencies because regulation still, they will be maintaining the ownership ledger and traditional style, but it's a start, baby steps.
Did they contribute?
Still though, that's so cool. Like it's amazing to see them actually, like, you know, the idea of tokenized treasuries and stablecoins, that whole interplay with TradFi, that's the thing I'm just like by far most excited about.
I mean, policy should be very constructive for Ethereum, right? And the new SEC chair regulates securities, not commodities like Bitcoin. So Ethereum's got a lot of the policy upside potential. You know, we know Solana and the Bitcoin community gave generously to the Trump campaign. What about the Ethereum crowd, though? Did they do enough? I don't know. But I agree with your point, Felix, as well. It's the funding leg. You know, Ethereum is up something like 20% in the last 2 weeks. It's kind of in no man's land where we stand right now, but we'll see. It's difficult. I agree with your point too. Like, you know, stick with the leaders is a pretty reasonable strategy, like Bitcoin at this point.
And there's just so much that isn't priced in yet. Stable in terms of regulation. I mean, stablecoin regulation is going to be first out of the stable, and that's, no pun intended, and that's going to be soon. I mean, possibly within the next 3 months or so. And then right after that, they've already got several drafts of an updated FIT proposal, which is going to be classifying the assets, and that is going to also incorporate, what I'm hearing, some clarification on what kind of DeFi services are allowed. And once we have regulation around DeFi, then we're going to have TradFi institutions playing with DeFi apps. And many of them are going to, if not be built on Ethereum, they're going to be connected to Ethereum somehow, because that is, for now, where the market is. And you also have the interoperability services, which will bring Solana apps into the fold as well. That Solana, with Alex on this, very much depends what happens to the meme coins, which brings us to the final segue into, I know we're tired of talking about meme coins because they go up, they come down, but Trump meme coin is doing well because of the power of a tweet from the sitting president of the United States of America.
It's destruction.
Any thoughts on when we will finally see the end of the meme coin pumps and dumps, if that's not too harsh a term?
I think a version of it is over, but I don't think you can ever kill speculation in crypto. It's just reinvents itself in another version. 2021 was NFTs. This cycle has been meme coins. I do think that, there's been a lot of grave dancing on meme coins, which I do think, if we do get another altcoin rally, could send those pretty significantly and piss a lot of people off. But I think ideologically, and the idea of just long pump fund and that idea, I do think it's over. I think now it's just mostly these rotational trades, and after enough people think that shorting meme coins is a free trade, then we squeeze them all. But I do think the idea of it is long dead.
That's refreshing. It will be very refreshing. However, one final question I have for all of you, and then we can start to wrap up. Meme coin rally or meme coin enthusiasm, a lot of that has been attributed to the lack of interesting movements elsewhere in crypto. In other words, if crypto is not moving, let's pile into something. I'm not saying I believe this is what I'm hearing. Let's pile into something that does move. So the speculative money has been concentrated in a relatively small corner of the market. When that changes, when we do enter the next leg of the bull run and altcoins start to move, do meme coins get speculative again, or does the speculative money flow into altcoins?
I think fool me once, shame on you. Fool me twice, shame on me when it comes to meme coins. People are burned. They're going to be reluctant to come back. But, to the extent that there is a pump there, it'll be in the leaders.
Yeah. I just don't think there's a lot of great options for retail right now. Like, altcoins are just a mess. Like, if you want to long those things, you need to get in front of 4-year unlocks, just nonstop, So I think I saw something going into 2025. There's about $32 billion of unlocks for altcoins for this year. Like, that is just, you can't get in front of that. So if that cuts off that amount of the crypto industry, and then you have meme coins, which are just, rotational pump and dumps, I think that's why I'm mostly just hiding out in Bitcoin. I think the L1 narrative is being tested right now in terms of value accrual. So I don't think it's as meaningful to hide out in there. So, I think a lot of the reason why we haven't seen such interesting innovations in terms of token structure has been the regulatory thing. And that only ended like a couple months ago, if you can even make the argument it ended. So I think it'll take time. I'm paying attention to the new token structures that get introduced to the market in the future. But as it stands, whatever exists today, I'm pretty pessimistic on.
Just wanted to point out on unlocks, which is very important. Most of these altcoins have massive unlocks regularly. One coin that stands out positively, ironically, on that front is Sol specifically. The largest unlocks they just finished. We have still large unlocks relatively on April, and then they go down by 95% May relative to March. And then go down another 50% from July onwards. Becomes very manageable in relative terms.
I think the main lesson from this meme coin drama is retail investors organizing, investing like a tribe. So I just shared my screen here, Noelle, if you can light that up. It's an article from the Financial Times today. And it says, it's called Retail Investors Take on Hedge Funds in Europe's Answer to Meme Stock Mania. So it's now in Europe, right? A handful of European stocks have become a battleground for retail traders taking on hedge fund short sellers. They're organizing on Reddit, like Wall Street Bets. They're identifying stocks that are heavily shorted. We talked about how you had 99th percentile short interest. And those hedge funds are short those kinds of names. And other names also. They're targeting hedge funds like Marshall Wace and Millennium, and European defense shares have soared. But I think this is the main lesson from the whole meme coin drama. It's retail investing has transformed markets post-COVID. Robinhood has transformed it. Coinbase has transformed it. Social media has transformed it. And
I think it's permanent too. I think what people mistake is they think that's a zero interest rate phenomenon. I think it's just a change in psychology.
I agree. Markets bottomed in October 22 at elevated PE ratios versus the norm. Generally didn't bottom at where we concluded that. And think about it, well, why are valuations elevated today? I would say it's because of this. Something I've been trying to sort out is, do you have a 19% correction like Q4 18 when you had Trump 1.0 trade war and you had a growth scare? We've only had a 10% correction. The bear case is there's more to go because valuations are frothy and earnings growth is slower. But this is the other side of it. We're now post-QE, post-trillion dollar stimulus, and retail investors are a sizable bid. It's not everywhere, but it's in those stocks. It's in those Twitter momentum stocks where they're creating the bid or they're creating, a short squeeze. So I agree. It's a permanent shift.
It's a psychological shift.
Mm-hmm. Ram, have you looked into looking at hedging positioning and puts comparing like Q4 2018 to right now? Because my simple framework is people are too hedged for it to go down like that. And I'm just curious if you've looked at the data from that Q4 2018.
I love it. You got to join the show more often, man. What possible question?
I know.
By the way, Forward Guidance is also my regular rotation. It's a terrific podcast. You really enjoy it.
Yeah, we got some good interplay between both our shows.
Right,
I love it.
That's right. So the answer is there was significant hedging demand and buying and put options in 2018. In fact, in the 3 days leading up to the bottom, which took place December 26th, on December 25th, Trump, I think it was on Christmas Eve or Christmas, said something to the equivalent of go out and buy stocks are cheap. So that marked the bottom. So, but yeah, there was significant put buying, and markets were heading lower despite the aggressive put buying, which we saw in this correction too, right? We saw like the put call ratios peaked like 2 weeks ago, and then the dip kept dipping. By the way, there's another phenomenal podcast with the interview with Charlie McElliott, who's from Nomura, their head of options. You probably
listen to that.
We should get him on this show too. But he was interviewed on the Odd Lots podcast. But the conclusion from all of this is that like the derivatives market's leading the spot market, right? And so that aggressive put buying behavior will force dealers to delta hedge by selling short futures. And it's really the sellers of volatility that are helping to equilibrate markets. So I think it's a really interesting concept to unpack. We should bring on Charlie on the show here and really double click into that.
It's also interesting from the market infrastructure point of view. You saw that Bloomberg reported, I think it was yesterday or today, that Coinbase is in advanced talks to buy Deribit. And the last reported valuation of Deribit was between $4 and $5 billion. I mean, that makes Kraken's acquisition of a derivatives platform last week for 1.5, the biggest until then. It makes it seem, nothing in comparison. I mean, these are big numbers, and the potential volumes must be astronomical.
I think that's such a good buy, though. Like Deribit is just phenomenal because I used to trade options a lot more than I do now. Now I mostly just use them as like long-term like leap calls is pretty much the only thing. But whenever I would look at on-chain options, the spreads were just so horrendous. I'm just like, there's no way anybody's actually trading these things. They're terrible. But the only exception was Deribit. It wasn't on-chain, but there was a lot of really good tight volume there, tight spreads. And, so much of the crypto industry is used to just trading perps. I think to whoever can capture that Deribit and bring it to retail, because I think it's still a lot of more sophisticated money on Deribit than, retail's still punting in perps. I think that's a really smart move for them to go after it.
I agree. I can't speak to the price, but it's great. And, look, zero DT options have been all the rage the last 2 years. It's all part of the same concept, going back to animal spirits, retail investors taking control of their trading. There's an app called Dub, which is a copy trading app. It's growing quickly, mostly organically.
What's the name again?
I think it's called Dub. And that's, those products are going quickly. So this is 2021 vibes for me. 2021, similar kind of setup. You had February
and breaking
back here.
And bringing in new markets. I mean, bringing in the kind of investor that wants all of their trading under one platform, which is something they get often in traditional finance, but in crypto, it's not been that common.
So when does the party end? I mean, I would look at like Palantir and names like that as like a clock. Palantir was down 40% from the high. Now it's down 20%. Again, in the last 2 weeks, significant rally. I think these retail investors they're smart. They're trader. They have a sense of what's going on. I don't think Palantir gets to the new all-time highs. And I just pick that one as an example across many. You could pick another one like HIMS, perhaps even Bitcoin, by the way. But I do think you get another rally higher. This rally is moving very, very quickly, though. So it might not mark out in time, like to the summer. It might mark out in price.
Yeah. One thing that's really interesting today is, I believe, so the EZU, the Eurozone ETF was red today. And we've seen like the last 2 months has been this huge rotational flow into Europe. I've been pretty excited about it, but the trade has gone too far too fast. Like there's like a Forbes magazine cover about longing rest of world equity. And I was like, oh, like crap, the trade's already over. And so to see that red on the day, like Mag 7 was so well bid, I think there's this huge repositioning again of like I keep saying pod shop monkeys because I just read like Shubstack's article all about it, and he used that nomenclature, and it's just such a great way of putting it. But yeah, I think they're piling up in that Mag 7, tech trade again, and the fact that it was red on today, I think, is the signal.
You know, one of Millennium's top holdings in the 13F filing was Reddit. Yeah.
No way.
So
can you imagine Reddit becoming like the meme stock of this cycle? That would be epic.
It's on my
That would be so meta. That'd be absolutely brilliant.
Yeah.
Speaking of which, and to wrap up here, have any of you seen the movie Dumb Money?
Nope. No.
It's excellent. It's the movie about the GameStop saga. And it's
I
really
did see
well.
that. Yeah.
It's really well done. I don't know if it's on streaming yet. I saw it on an airplane, but it was much, much better than I expected. And I think it is going to have a strong cultural influence once it hits streaming.
The weirdest thing was just having Seth Rogen be a hedge fund manager. I just couldn't take him seriously in it. I was like, this is Seth Rogen. He smokes weed. He's not a hedge fund manager.
I think that's also the kind of the point of the movie. So.
True. Yeah, fair point.
Anyways, we got through a lot today. I thank you all very much for being here. Felix, thank you for joining us. We got to get you back on. And Ram and Alex, thank you so much for being here also. Thanks all of you for listening. We'll be back in 1 week to discuss more about how the worlds of crypto and macro are colliding. Until then, everyone.